Hi everybody, welcome to part 2. So we're analyzing our fair value net income investments, and we can see that they have a realized gain of $13,000. Realized gain means they've actually sold it and they realized that gain, so they've received the cash. They also have unrealized gains of $11,000. So this relates to that fair value bump at the end of the year. We know that this fair value bump is going to be recorded into the fair value net income investments T account. So we're going to have 11,000. This is our unrealized gain. So we're accounting for all of these things. That $13,000 of realized gain is included in this $37,000. It's the bumps in the investments that were sold. Now we need to determine, does our T account now make sense? Well, no, it doesn't. We're still missing something. It is still not true, the mathematics of it. So we're going to have to figure out what else could affect it. What else could make it increase? Well, we could have a purchase, right? So if we start with our ending, subtract off, we can see we must have had a purchase of $5,000 of investments, okay? So we have two things happening here. We had a sale. Well, we know what is taking off the books and records is not actually what we received in cash. If we read that narrative, it said our proceeds were $50,000. Well, what is the cash figure here? The cash figure is the proceeds that we actually received. And the purchase, our cash outflow relating to our fair value net income investments, is the purchase of this $5,000. Okay, so we've got two items that involve cash relating to these fair value net income investments. So I'm going to have them separate. So I've got a purchase of fair value net income investments. And I'm going to go grab that $5,000. It's a purchase, meaning money going out the door. So it's going to be a negative number. And if I'm receiving proceeds, my cash is going to be increasing. So here I am. I've got the purchase and the relating cash outflow and the proceeds and the cash inflow recorded. And I'm going to keep looking at my changes in working capital. Okay, so now I see that there is a change in inventory, and inventory has increased. So I've got an increase in inventory. I'm going to treat it the same way. I am going to be adding the prior year, subtracting the current year. Okay, so I get cash outflow of $14,000, which makes sense. If my inventory has increased, well, how did I pay for that increase in inventory? I must have had to have used cash to pay for it. So I'm going to highlight it yellow. I've taken care of that. Next, I see I've got my deferred tax asset. So I'm going to have to adjust for the change, and it looks like it has decreased in value. So I've got a decrease in my DIT. I'm going to treat it in the exact same way. Okay, so I'm adding the prior year, subtracting the current year. Now I take a look. I think I've taken care of all of the assets that would affect my operating income. I know equipment, buildings, and land are going to affect my investing section, not operating activities. So I scroll down to my credit balance here. Accumulated depreciation, again, going to be involved in investing, but I've got accounts payable. Accounts payable has increased. So I've got an increase in AP. Okay, now let's just think about this for a minute. Accounts payable, a current liability. So our accounts payable from 2022, we would expect that we have actually paid the accounts payable from 2022. We expect that we would have paid it within 12 months. So that would be a cash outflow, okay? We have not yet paid the 2023 amounts. So we would want to add those balances. So all liabilities behave in the same way. So we're going to add our current year and we're going to subtract our prior year. So they behave in the opposite manner to our assets. I'm going to highlight it. I have taken care of it. And I'm going to continue going through what else I see that would affect operating activities. And I've got my income tax payable, and it has increased. So I've got an increase in taxes payable. I'm going to approach it the exact same way. Add my current year, subtract my prior year. Oops, got the wrong cell there. Income tax. So I've got an increase in cash of $2,000, and I've got an accrued pension liability. I'm going to highlight that one, and it has decreased. And I'm going to add the current year, subtract, oops, that didn't quite work in the way I was planning. I am going to add the current year, subtract the prior year here. Okay, and when I look through here, I know accumulated depreciation and equipment, PP&E, investing, long-term notes payable, going to be a financing activity. Common shares, retained earnings, going to be a financing activity. So I think I have captured all of my operating activities. So I can go ahead and total them up and then add them to my net income figure. And I can see I've got net cash provided by operating activities of $105,000. Then I can move on to my investing activities. So looking at my investing activities, I know the main thing here that's going to be affected is my PP&E, and I've already started my analysis. So I can come on down here. I know that I have additions here, so I need to further analyze those additions, and I need to analyze this sale. How much, what proceeds did I actually receive on the sale of this equipment? Okay, so I know I can use my little formula. My proceeds less my net book value is going to equal my gain or loss that gets recorded for accounting purposes. So my net book value, $10,000 minus my accumulated depreciation. And I know my gain or loss by going and looking at my income statement. So if I have a loss of $3,000 and my net book value is $6,000, I must have received proceeds of $3,000. Okay, so my proceeds must have been $3,000 that I received on that sale. So I'm going to come on up here. I'm going to put proceeds from sale of equipment. And I'm going to have $3,000 to record there. Okay, and now I need to go ahead and look at those additions and determine, were any of those additions paid for with cash, or were they all for trade? So I'm going to come and I'm going to read some of these details again, and I can see common shares were issued in exchange for land. No other land was acquired or disposed during the year. Okay, so our change in land, if we come up here, our land has increased by $15,000. So if we come down here, we've got additions. Okay, so we've got additions of total, $47,000. We had it in exchange. Just going to add a little column in here. Oops, where am I? Maybe I am not. So I'm going to come down here and just have a little more space. Additions. So I know land for common share issuance was $15,000. Okay, I know I've got a total of additions of $47,000 right here. Okay, so I need to go account for, are there any other non-cash items that are affecting my PP&E? So I'm going to go continue to look. So if I look here, I can see common shares were also issued for equipment purchases of $20,000. So if common shares were issued, that means that's a non-cash item. What would my journal entry be? It would be a debit to equipment, a credit to common shares. So I have another non-cash item to account for. So equipment for common share issuance of $20,000. That's all the information I have. So I'm going to now see, is there any other purchases that were made? And there were $12,000 of other purchases that were made. So these must be cash purchases. Cash purchases going to affect my cash flow statement. So I'm going to come on up here and be able to include purchases of equipment, purchase being a cash outflow, so going to be a negative number of that $12,000. Now I don't have any other long-term assets to look at, so I'm going to go ahead and I'm going to total these up to be my cash flows, net cash used by investing activities. Okay, so I've got $9,000 cash outflow. Then I can go ahead and get into my financing activities.